In December, we published our 2025 market and economic outlook. It's all fun and games until someone gets hurt. After strong November equity market performance, many traders expected the rally to continue in December, but this didn't happen as most leading equity indices declined for the month. However, even with the year-end thud, 2024 was a strong year for most equity investors, highlighted by a 25% total return, including dividends, for the S&P 500 equity index. Market gains were driven by better than expected U.S. economic growth, anticipation of lower Federal Reserve Bank interest rate targets, and year-over-year corporate earnings growth. Gains were also boosted by President-elect Trump's campaign promises of a pro-growth agenda, highlighted by deregulation and lower taxes. And we believe that these positive market drivers are likely to continue in early 2025, but December's weakness was a reminder that investors should consider risk and market pullbacks are expected. We believe that the late year weakness was caused by rising long-term interest rates, some profit taking after strong annual gains, and uncertainty about potential disruption once the new administration takes power. So now I'll outline highlights of our 2025 market outlook. We believe that equities can move modestly higher in 2025 and expect better performance from the average stock. We also believe that Trump is good for growth, but beware of tariffs and immigration plans. We also think the Fed will slow its pace of interest rate cuts, keeping interest rates higher than expected. And then finally, we must consider market risks that include weak jobs growth, higher inflation, and budget deficits. U.S. economic growth, as measured by gross domestic product, or GDP, is expected to have grown 2.7% in 2024, the year that just ended. And this is well above estimates that existed at the beginning of the year, and also a little bit better than GDP growth for the 5 years prior to the pandemic. From 2015 to 2019, annual GDP averaged about 2.6%. But growth is expected to moderate to 2% in 2025 and 2026. But this is not a recession, it's an environment supportive of earnings growth. But we don't expect earnings estimates to be revised higher, which could limit market upside. When we look at the S&P 500 valuation, we can divide the price value of the index, which was just below 5,900 at the end of 2024, by the weighted average of earnings estimates over the next 12 months, which is the PE ratio. On that basis, the S&P 500 trades at nearly 22 times 2025 earnings estimates, which is well above the average of 18.5 times over the past 10 years. We believe that the S&P 500 percentage gains could trail growth in earnings in 2025, but still the index can move higher. Our estimate of fair value for the S&P 500 is 6,300, which is about 7% above index levels at the end of 2024. Despite a strong 2024 year for equity returns, however, gains were concentrated in a relatively narrow group of stocks. For the S&P 500 full year, 4 macro sectors out of 11 posted gains above 28%, driving the index. These were communication services, technology, consumer discretionary, and financials. And 4 other sectors severely lagged, with gains of just 2% or even lower. In December, which was a down month for the index, 3 sector leaders were the same in December as the full year leaders. From July through November, including the post-election period, market gains had broadened to include more sectors, but that reversed in December. And we believe that broadening of sector performance can resume in 2025, and caution against becoming too overweight in a narrow group of stocks. Another way to look at it is to compare the S&P 500 to the equal weight S&P 500. While the S&P 500 is weighted by market capitalization so that a handful of companies have an outsized impact on index performance, the equal weight S&P includes the same 500 companies but gives each an equal weight. In 2024, while the S&P 500 gained a little more than 23% on a price basis, the equal weight return was just 10.9%. Over time, both indices tend to deliver comparable returns, and we expect improved relative performance from the equal weight index in future periods. In anticipation of Trump administration policies has rekindled animal spirits, as deregulation and a potential further decrease in the corporate tax rate can stimulate business investment and boost GDP estimates. However, we expect puts and takes as the year unfolds. Several policies will involve Congress through the budget process, which could take time, while other actions, including potential tariffs and immigration changes that could disrupt labor supply, can happen without congressional approval. The uncertainty as policies are considered and then implemented could weigh on investor sentiment, causing volatility. The Federal Reserve Bank, or Fed, manages U.S. short-term interest rate policy by setting target ranges for the overnight bank lending Fed funds rate. But yields on U.S. Treasury bonds, especially from 2 years and longer maturities, are market traded and fluctuate along with economic and inflation expectations. The low end of the Fed funds target range at year end was 4.25%, down from 5.25% at the end of the summer. That's because the Fed reduced its targets by 100 basis points. But then since early 2024, the 2-year Treasury yield, which is again market traded, was moving lower from a high of 5% all the way down to 3.6%. But since late September, the 2-year yield has traded significantly higher, back to 4.25%. And this suggests to us that bond investors don't expect the Fed to aggressively reduce the Fed funds target from where it ended the year. So interest rates in 2025 could remain higher than we previously expected. One reason for this is that economic growth has been resilient and exceeded expectations, but another reason is that inflation improvement has slowed in 2024. The Consumer Price Index on a year-over-year comparison is reported monthly. Headline CPI includes a full basket of goods and services, and core CPI excludes more volatile food and energy prices. The Fed wants to see both inflation measures get back to and remain at 2%, and significant progress has been made since mid-2022 when inflation peaked, but still inflation is closer today to 3% than 2%, so more work is needed. Higher interest rates reflect market expectations that sustained inflation gains in 2025 could be harder to come by. Balanced against early 2025's solid economic outlook are prevailing risks that could cause volatility and should be watched closely. This includes our previous comments about slowing jobs growth and higher interest rates. In addition, ongoing federal budget deficits continue and will require congressional action in 2025 to both increase the statutory debt ceiling and to pass a budget. Also, following 2 years of strong gains, a bull market that began in October 2022 could encounter headwinds in the third year from the low. With a positive economic environment, along with high valuations and policy uncertainty, we want exposure to high-quality companies, remaining invested in broadly diversified portfolios. Our familiar recommendation to rebalance portfolios on a regular cadence remains important, and look for opportunities to upgrade and reposition during periods of volatility. We'll provide frequent updates as the year moves ahead, and for specific recommendations and strategies, please contact your D.A. Davidson Financial Professional.